Welcome to Perspectives Eye. In the world of real estate, not everything is as it seems. Behind the polished facade of a property sale or purchase, hidden dangers can lurk. Learn how to protect yourself from scams, fraud, and other risks in this informative video. We will share with you how to properly implement an anti-money laundering program for the real estate sector. This video is divided in 3 parts: the program, transactional risks, and the risks posed by key players. Within the program, we want to include the following pillars and internal controls: a risk assessment, customer due diligence, transaction monitoring, record keeping, training, independent testing or evaluation, and reporting and compliance. As part of your risk assessment program, you must identify high-risk activities. Transactions that pose a higher risk of money laundering include cash purchases and monitoring individuals from high-risk countries. You must assess customer risk, include factors like geographic location, source of funds, and nature of the transaction. Develop risk mitigation strategies, enhance due diligence, or additional reporting requirements. As part of your customer due diligence program, you must obtain identification from buyers and sellers, include collecting a government-issued ID, proof of address, and financial statements. Verify the information. Confirm the collected information through independent sources. Enhance due diligence. For high-risk customers, conduct enhanced due diligence, including background checks, beneficial ownership verification, and source of funds documentation. For your transaction monitoring program, establish a monitoring system. Track and analyze transactions for suspicious activity, such as large cash payments, unusual patterns, and sanctioned individuals or entities. Set thresholds. Define specific criteria for triggering alerts, such as exceeding thresholds or unusual activity patterns. Investigate alerts. Investigate any suspicious activity and report findings if necessary. As part of your record-keeping program, you must maintain records. Retain accurate and complete records of all customer interactions, transactions, and due diligence procedures. Retention policy. Establish a clear retention policy for records, ensuring compliance with applicable legal requirements. Secure storage. Store records securely to protect against unauthorized access or loss. Training program. Provide training. Conduct regular training programs for all employees involved in real estate transactions, covering AML regulations, risk assessment, due diligence procedures, and reporting requirements. Raise awareness. Promote a culture of compliance within the organization, emphasizing the importance of AML measures and the potential consequences for non-compliance. Independent testing or evaluation program. You must conduct regular reviews. At least annually, assess the effectiveness of the AML program through independent testing or evaluation. Identify weaknesses. Identify any deficiencies or areas for improvement in the program. Implement corrective actions. Take prompt corrective actions to address identified issues. Reporting and compliance program. File suspicious activity reports, also known as SARs. Report any suspicious activity to your jurisdiction's relevant authorities. Comply with regulations. Ensure compliance with all applicable AML regulations. Maintain documentation. Document all reporting activities and compliance efforts. As part of your transactional risk, you're going to evaluate the risk based on the stage or phase. And these include the pre-approval, finding a property and making an offer phase or stage, earnest money deposit, due diligence period, mortgage approval, closing costs, closing and possession stages or phases. Under your pre-approval, finding the property and making an offer stage, you will have the lowest risk. Why? Because of the preliminary phase that this involves. Now, the risk immediately goes up or increases at the point of the earnest money deposit. Upon accepting your offer, you'll typically need to provide an earnest money deposit. This is a sum held in escrow by your agent to show your commitment to the purchase. Why would the risk be higher at this point? Because of potential large cash deposits that can be a red flag for money laundering. How to mitigate this high risk? Encouraging electronic payments or bank drafts. Verify the source of funds through due diligence. The due diligence period also represents a high risk. At this stage, we see the home inspection, where there is an assessment of the property's condition and identify any potential issues at this stage. We also see the appraisal, determining the property's fair market value, and the title search phase, where there's a title search conducted to ensure the seller has clear ownership. The potential high risk at this stage is due to the presence of potential use of shell companies and overvalued properties. How to mitigate this risk? Verify beneficial ownership and obtain independent appraisals from reputable sources. The mortgage approval phase also represents a high risk. At this stage, we see the submission or submittal of loan applications, where we submit a formal mortgage application to the lender. We also have the gathering of documentation, where we provide required documents. And there's also a loan approval stage, where there's a review of the application and determine the qualification for the loan as applicable. The high risk is due to the fraudulent loan application and loans that can be used for laundering potentially. How to mitigate these risks? Verify the authenticity of documents, verify identities, and look for suspicious patterns. Closing costs. Why would we see a high risk at this stage? At this point, we see the estimate closing costs. Costs such as title insurance, appraisal, attorney's fees, among others. And also the preparation of funds. Enough funds to cover a down payment and closing costs and any additional expenses. The high risk at this stage could be due to large cash payments for the closing costs. How to mitigate these risks? By encouraging electronic payments or bank drafts. Verify the source of funds. The closing stage. Why would this be a high risk stage at this point? We see here the signing of documents, signing of legal documents, the transfer of title, where the title to the property is officially transferred from the seller, and the disbursement of funds. The lender, in this case, as applicable, disperses the loan funds to the seller, and you pay any remaining closing costs. The high risk is due to potential large cash payments for closing costs. How do we mitigate this high risk? By using reputable escrow agents, verifying the authenticity of the documents as well. At this point, we go to the possession, where the risk immediately decreases because at this point, the due diligence and any other verification of documents and processes has been determined, and at this point, we close the transaction. Players and the risks that they pose. We have a buyer, a seller, a real estate agent for the buyer and seller, a mortgage lender, a title company, a home inspector, an appraiser, an attorney, an escrow agent, and a surveyor. Why would a buyer represent a high risk at this particular point? With high risk jurisdictions, buyers from high risk countries or jurisdictions may be involved in illicit activities. There may be also a presence or use of shell companies, where buyers may use shell companies to conceal their identity and source of funds. There may be use of cash transactions, where large cash payments can be a red flag for money laundering. Why would a seller represent a high risk? Due to structured transactions. Sellers may engage in structured transactions to avoid reporting requirements. We may also see the presence of wire transfer fraud. Sellers may be targeted by wire transfer fraud schemes where funds are diverted to fraudulent accounts. And we may see the presence of overvalued properties, where properties may be intentionally overvalued to facilitate money laundering. Why would we see the high risk within the real estate agent? Due to potential collusion with criminals. Agents may collude with criminals to facilitate money laundering schemes. We may also see potential kickbacks and bribery, where agents may receive kickbacks or bribes from clients involved in illicit activities. We may see negligent AML practices, where agents may fail to implement adequate AML procedures or report suspicious activity. Why would we see a high risk with a mortgage lender? Due to money laundering through mortgages, where borrowers may use mortgage loans to launder money. We may also see the existence or the presence of fraudulent loan applications, where lenders may be presented with fraudulent loan applications enclosing false information. And we may see the presence of identity theft, where loan applications may be submitted using stolen identities. Why would we see high risk with a title company? Due to instances of wire transfer fraud. Title companies may be victims of wire transfer fraud schemes. We may also see forged documents, where title companies may be presented with forged documents to facilitate fraudulent transfers. And we may see potential instances of negligent title searches, where title companies may fail to identify liens or encumbrances on properties. Why would we see a high risk with a home inspector? Due to bribery and kickbacks, for example, where home inspectors may be bribed to overlook defects or provide false reports. We may see potential collusion with sellers, where inspectors may collude with sellers to conceal property defects. Why would we see high risks with an appraiser? Due to inflated valuations. Appraisers may intentionally inflate property values to facilitate money laundering. And we may see instances of kickbacks, where appraisers may receive kickbacks for providing inflated valuations. Why would we see high risks with attorneys? Due to negligent AML practices. Attorneys may fail to implement adequate AML procedures or report suspicious activity. But they may also lend themselves to facilitate illicit transactions, where attorneys may assist clients in structuring transactions to avoid detection. Why would we see high risk with an escrow agent? Due to potential wire transfer fraud. Escrow agents may be targeted by wire transfer fraud schemes. We may also see instances of misappropriation of funds, where escrow agents may misappropriate funds for personal gain. And the surveyor. Why would we see high risk with the surveyor as a key player? Due to falsified surveys. Surveyors may provide falsified surveys to facilitate fraudulent land transactions. Furthermore, we may see the potential cases of collusion with criminals, where surveyors may collude with criminals to facilitate land fraud schemes.